In this video, I'm going to take a look at the performance of the Forex portfolio that we have been running and the two strategies that have been used. So to begin, let's take a look at the performance since we started to publicly post and log these trades. The first trades were placed just over 3 weeks ago on the 15th of October. So if we step forward week by week to take a look at the performance. So after the first week, the total assets had increased from the starting balance of 10,000 to 1,416. So that is approximately 14% return. On the second week, the performance improved to 2,800, so roughly 28%. At the end of the third week, clipped on another couple of percent, so almost 29 or just over 29%. And as of today, the 8th of November, another approximately 1 or 2% have been added to the overall return. So during this time, two trading strategies have been used. One was based on creating trend lines and trading between channels or trading breakouts on trend lines. The other strategy has been based on using technical indicators only, and they've been fully automated. So if we take a look at one of the symbols, such as the euro dollar that has been using this strategy, in total 2 symbols have been using this strategy, the euro dollar and the euro pound. So if we take a look at the euro dollar, and look at this performance over the weeks. So we started running this symbol or this strategy approximately 2 weeks ago. So between the 22nd and the 29th, or actually between the 28th and the 29th, this strategy was working very well, generated $974. Over the following week, which was last week, it didn't deal very well with the volatility and give up those gains, generating a loss of just over $1,000. And again, over the last few days, it's been mixed performance, not really losing, not really gaining. So let's take a look at this strategy and take a look at the rules and see what can be done to improve upon them. The strategy that was used on the euro dollar and the euro pound, the moving average based on 100 periods was decreasing and the RSI rose above 60. We were selling to open a position, and so the theory is, while in a downward trend, if the price rallies and the overall trend is down, you sell to open a position on the principle that the price will correct. So with this rule, we had when the moving average decreases by a very small percentage, 0.0001, and the RSI rises above 60. They can happen in any sequence, but both of them have to happen within 2 candles, as in this rule is based on a minute based interval, and so is the RSI. So both have to happen in any sequence within 1 minute. Sell to open, take a profit of 40 pips and a stop of 20 pips. So if no position, execute this action, which means if this rule happens repeatedly and the limit or the stop from the first time round have yet to execute, then you will not get an incremental position. Only one open position at a time. On the flip side, we had another rule that said if the moving average increases, so if the moving average is rising and the RSI moves against it, showing weakness in the price, so the trend is up and the RSI is suggesting that the price is at a low or at a weak point, this time we buy to open, and again 40 pips profit, 20 pips loss. So the reason why I adopted this trade in the first week was because of backtesting results that I carried out. So if we take a look at those results, and then reanalyze it or historically backtest and try and optimize the performance of this strategy. So if I go to backtest, first of all I'm going to look at previous backtest results when I was developing this strategy. In the testing, so based on a limit of 40 pips, a stop of 20, etc., the return was over $5,000. However, during that time the markets were not as volatile as they were in the previous week, and it has transpired that during periods of high volatility, possibly the stop is too tight. So what I'm going to do is retest these strategies and look for an optimized or an improved set of stop values or limit orders as far as that goes. So first of all, let's just test the existing rules that we have been running over the last week to check if they correlate with what we saw in real trading. So the performance is largely in line with the simulated trading. If you look closely at some of these results, there is a difference between the forward testing or the testing in the simulated account versus the back testing, and that comes down to the spread between the opening price. So when we have come up with a new strategy, we have to also test the sensitivity to various levels of spread. Obviously, with a profit of 40 pips and a loss of 20 pips wasn't a very successful strategy, so I'm going to rerun the strategy and look for a better set of stop and loss values. So what I'm doing here is setting the starting value for the stop and the limits at 10 pips, and then incrementally increasing each of the limit and the stop values by 5 pips each. Okay, if you scroll down, it's suggesting that an optimized limit of 50 pips versus a stop of 40 pips may have worked better over the last week versus the previous result of a loss of 3,600. And what I'm looking for now as I go through the stop and limit combinations that were back tested is a zone where there's generally a good range of profitability. So if we look, for example, 40 pips plus or minus 5-10 pips was a profitable strategy on the stop and the loss. So if the limit opens at a higher or lower value, there's a good chance of profitability. So what I'm going to do is change the stop to 40 pips on this strategy. And now I'm going to retest it. I'm going to add a spread to the figures to see how well the strategy holds up. If anything, it looks like the spread has actually improved the performance. When I add the spread to 2 pips, it's still profitable. I'm going to extend it to 3. Based on a stop and a limit of 40 pips, this strategy is able to tolerate so far up to 4 pips or 3 pips of spread and generate a profit. So we should sit back and see if this improves the performance of this strategy over time, and we'll come back to it later.